Welcome back. This is Open Exchange, and we are coming to you live from the CNBC-TV18 Motilal Oswal studio. Well, plenty of stocks to talk about, and we're getting into pre-open, but Prakash Diwan is still with us. Prakash, you briefly mentioned on, the steel stocks, but what about the iron ore maker? That's NMDC. There are various reports, I'm still trying to get it confirmed, there could be a marginal price hike that they've taken yet again of a couple of ₹100. What's your view on the stock? We had that, now it's a cleaned out entity. You have the separate listed NMDC Steel and you have NMDC, the iron ore miner as well. So what's your view on either of these names or both of them?
So Nigel, as a corollary to the upcycle in steel that I'm anticipating, and particularly this time it's going to be led by both the vectors, demand increase as well as a price hike. It is definitely going to percolate down to the ore side as well. So NMDC definitely stands to gain. In fact, I was anticipating a price hike somewhere in the middle of March. Probably hasn't happened. And given the fact that the Chinese economy is also taken a little bit longer than anticipated to rev itself up. And the data that you'll start seeing come out of China will probably be the deciding triggers for all this ore hikes, price hikes in the ore side. But yes, definitely NMDC stands to gain. In fact, we are in such a situation that right from NMDC to NTPC to anything that has N before it is likely to do well given the cycles that we are in the old economy stock. So yes, I'm quite positive, but only on the iron ore side of the business, not the NMDC steel unit, because you'd rather go for a more well-established and mature business if you were to buy steel. And as I mentioned, Tata Steel to me offers one of the best opportunities.
Okay, all right, Prakash, thanks a lot for joining and have a great day. The pre-opening sessions, by the way, has kicked in, and it looks like it's going to be a green start. It's a 30-point uptick on the Sensex. The Nifty as well is in the green. We have Rajesh Palvia, who's the Vice President, Technical and Derivative Research at Axis Securities, who's joining in now. Rajesh, hi, good morning. Do you think that this is a pullback rally that has legs to itself? And if yes, what are the stocks that you'd look at this morning?
Good morning, Sonia. So since last 3-4 trading session, we are witnessing that Nifty is trying to hold a 16,900 level on a closing basis, and the same way Bank Nifty is holding 39,000 level on the closing basis. So these two levels are very important as of now for this pullback rallies which we are seeing since last 3-4 trading session. So major put base for Nifty is at around 16,900. So if we hold those levels, then possibly we can expect some pullback rally towards 17,100 to 17,200. To play this pullback, we are initiating here call ladder strategy, 3-leg strategy. We will buy 17,000 call option at 106, and we will sell 17,150 call option at 46 rupees and 17,200 call option at 32 rupees. So your net outgo would be 28 rupees. So your risk is limit to 28 rupees. You have to keep a stop loss of 17,250 if at all Nifty crosses before this weekly expiry above 17,250, then only you have to exit from this strategy. Else we are expecting that, as we are getting pullback rallies, so 17,000 to 17,200 could be the profitable range for this call ladder strategy. On the stock front, we believe that, some buying interest is happening at FMCG space. So Godrej CP is looking attractive. Godrej Consumer Product, one can buy this stock as it's a third consecutive day where we have seen higher high formation and long built up is there. So Godrej CP, we are recommending here to buy for upside target of 985, 995. One can keep a stop loss of 955. Another stock which we like from OMC, that is BPCL. It's a third, fourth week where we are seeing, sustained buying is there in BPCL, and stock managed to give breakout on the near-term chart also. So BPCL is a buy for upside target of 385, 390. One can place a stop loss at around 345. Third stock is on the sell side, that is from cement space, India Cement. One can go short. Stock has given a breakdown to its multiple support area, and short built up is there in the previous session. So we believe that India Cement can go down further from current level. 170, 168 could be the possible target on the downside. One can go short with stop loss of 185.
All right. Thanks very much, Rajesh. Appreciate you joining in with those call on the index and, of course, specific stock trades as well. Now, momentumizers is the next what we're going to talk about. And Abhishek has got his eyes on Muthoot Finance, which is in the spotlight. Abhishek, over to you.
Well, Muthoot Finance is in momentumizer list today. The stock has outperformed Nifty in last 1 week as well as last 1 month. So weekly change that you are seeing, Muthoot Finance is up nearly 2.5%, while Nifty is down 0.3%. On a monthly basis, Muthoot Finance is down 4%, but Nifty is down 4.7%. Yesterday's volume data is interesting. It was about 124 crore. The average run rate over the last 2 weeks or so has been anywhere between 15 crore to 57 crore. Monday's delivery volume was around 36.5%. If you take a look at where the stock is in terms of the pricing levels, it is at 946 in terms of CMP, which is below the 20 DMA of 953.2. So gold finances are in focus as gold price hit 60,000 yesterday. Higher gold price augurs well for gold finances. Historically, gold price and balance sheet growth of gold finances have moved in high correlation. Back to you.
Okay, thanks a lot for that. So we will be connecting with the management of Muthoot Finance. That happens at 9:40 a.m. on Bazaar today, so do stay tuned in for that. But the other space that we're looking at this morning is the auto space, because the auto stocks have started to correct. In fact, this year so far, M&M is the biggest Nifty loser. The stock now is down almost about 7-8% this year. And, Basudev Banerjee, who's the auto analyst at ICICI Securities, joins us now to talk more about that. The auto index itself is down 5% in a month, Basudev. Do you think it's because of the possibility of, a weak monsoon, the El Nino, which is perhaps going to derail auto sales further? Is that your base case? And what do you do with individual stocks then?
Sonia, morning. So if you look at auto index has corrected by almost 8% in last 6 months against Nifty falling by 4%. And before that, auto index outperformed by 22%. So definitely this recent correction is combination of three things. One, obviously the market correction on a weak mode. RD norms coming in from April, where in commercial vehicles, 3 to 4% price hike. In select diesel vehicles, price hikes anywhere around 20, 30, 40,000. And last but not the least is where we are coming out of weak rural sentiment for last 18 months. Now the incremental risk of El Nino giving outlook for another weak monsoon and continuation of weak rural demand, let's say, in the specific segments. So all these things combinedly resulting in correction, and valuations of select large caps also moved up very much, leaving hardly anything on the table left. So that's an opportunity for long-term investors to look in this kind of correction.
M&M is one of your top picks, right? I was just mentioning a while back, this month M&M is down about 8% in a single month. You think this is a good time to buy into M&M, or do you think one can get better levels over the next couple of weeks?
So Sonia, if you look at, we had a neutralist stance on M&M in this whole rally. Now, when stock has corrected almost 20% from its highs, and if you do a sensitivity analysis of where Street was expecting somewhere around 6 to 8% tractor industry growth in fiscal 24, because of El Nino, even if you take it to a study where the growth is 0% or minus 10%, still you can't see this kind of valuation levels. So definitely, even if you look at the numbers on a conservative way, 1150 or anywhere below, along with time value of money, M&M is giving a good opportunity. And especially if you look at M&M has cleansed up many of those loss-making subsidiaries in last couple of years. So at least those baggages are no more there in overall scheme of things. Auto segment where demand for the SUVs, XUV 700, Scorpio, still they are operating with a good waiting period, and management is going to increase capacity by December. So M&M definitely is worth having a look in the large cap space in this ongoing correction.
What about Maruti? Because, there are now talks that demand is slowing down, inventory levels are high, bookings are not that great. And Maruti, when we chatted with them, told us that they expect just about a 5 to 7% growth for the industry next year. So there's definitely a slowdown underway. What do you do with a stock like that?
Since the last comment which you made, that 5 to 7% is slowdown for the industry. So it's a relative comment, because long-term car industry growth in India is hardly 5% for last 10 years. In FY23, industry is seeing 20% plus growth. So relative to that, you might feel a slowdown, but on an absolute basis, 5 to 7% growth for car industry in India is pretty decent. So that's a relative way to look at. And yeah, so for Maruti, the portfolio, the rural centricity of portfolio is relatively larger compared to the likes of a Kia or even Mahindra or even Tata Motors currently, or leave aside the other premium brands. So definitely the outlook for continuation of weaker rural sentiment will have an overhang on Maruti, where the entry-level models are very much dependent on rural markets rather than the urban markets.
Okay, all right. Well, thanks so much, Basudev, for stopping by and giving us your view on the auto space. Looking forward to chatting up with you rather soon. Well, it's 9:10. Then we've got the pre-market rates that are in. The Nifty is likely to open up with a gain of around 70 points. But for the time being, let's get in Sudarshan as well as Mitesh for their 9:10 call. Sudarshan, you go first.
Well, Hind Liver is a buying opportunity with a stop under 25.50.
Mitesh, you?
I'll go with the buy on Godrej Consumer with a stop below 949 for targets of 985.
All right, gentlemen, good to get those calls. Now, Nimish is standing by with the standout brokerage report for today. Nimish, hi, morning.
Hi, morning, Prashant. So today's standout is on city gas companies. CLS has today upgraded IGL to buy from outperform, and they've raised the target price sharply to 585 versus 420 earlier. They maintain a buy on MGL, and there they've raised the target price to 1260. Now, CLSA believes that the regulatory regime is going to change and will become more favorable from April 1st, and the pricing power is returning for the city gas companies. In fact, the proposed formula of gas price ceiling at $6.5 MMBTU will drive a 24% cut in the domestic gas prices from April 1st. Not only that, the CNG demand is going to be strong, and all the OEMs are pushing for it, which will mean that there will be a volume driver as well for the city gas companies. In fact, CLSA on IGL, they've raised the EPS estimate by 6 to 15%, and they believe that double-digit volume growth and pricing power is a rare, and hence they've upgraded IGL to a buy today. On MGL, they've maintained a buy, but they've raised the target price largely because they've raised the multiples from 11 times to 13 times, and hence on MGL the target price now is increased to 1260. But a big upgrade is on IGL to buy now from CLSA, and there they've sharply raised the target price now to 585.
All right, thanks a lot, Nimesh, for that. Well, the other stock that we're looking at this morning is Reliance Industries. Now, this is the third positive brokerage report that has come in on Reliance Industries in the last 1 week. CLSA has put out a note where they say that Reliance is now a bargain buy. They talk about how Reliance has fallen 20% in just 4 months and now is within 5% of its conservative valuations, which means it's a great opportunity for long-term investors to get into the stock. They have a target price of $29.70, which is a 35% upside to the current market price. They talk about various triggers that the company has in the near future: the launch of the 5G smartphone, the $25 billion 5G foray, a good chance of a Jio or a retail IPO in the next 12 to 18 months, and a $10 billion capex for the new energy foray as well. So all of these triggers could result in an upside for the stock, but let's not forget the stock has had a big correction. It's down 20% in the last 4 months alone. In fact, Mitesh is with us. Mitesh, at this 2200 price, is the risk reward favorable both for long-term investors as well as for traders?
See, I think while the risk reward keeps on improving with prices coming down, the longer-term charts are not showing any signs of reversal as yet. So I think once the stock stops falling, does some base building, and that could be in this range of about 2160 on the upside to about 2050 on the downside, I think then we might see a reversal. So there's still many more weeks to go before some kind of a stronger reversal can take place over here. So it remains at a accumulate on declines kind of a call over here, because I suspect 2150 might not break immediately, and therefore that works as a very good long-term support zone, but a reversal might take some time.
All right, we just have a couple of more seconds before the markets open for the day. So we've seen, of course, a big relief rally in the global markets as well. And for our own markets too, looks like the start is going to be well in the green. Remember, the Dow is up almost 400 odd points. But the important bit for our own markets is that every rally, every pullback has gotten sold into. So that perhaps is something that, our markets can see in the near future as well. The big trigger to watch out for undoubtedly is the FOMC policy. A 25 basis points rate hike is the expectation, but will the Fed change course given that there's been so much turmoil in the banking space globally? That time will tell. But for now, markets are definitely a bit tentative as we head into a brand new day. A couple of stocks that you'd perhaps want to look at this morning. The banking space has been under pressure for the last few days. Is there any kind of pullback here? We'll wait and watch. But for now, the first tick on the market coming through in just about seconds from now. It's an 80-point up move that you're seeing on the index, 83 points now, 90 points higher. So yes, the pullback has come through, led by Reliance Industries, up over 1% over there. Adani Enterprises up 1.5%. So all the losers of the last fortnight or so, some pullback coming in there. Bajaj Finserv, Bharti Airtel, HCL Tech, Hindalco, Britannia are all in the green right now. Nestle is the other stock that's trending in the green at the moment. On the downside, you have ITC, JSW Steel, Tech Mahindra, Grasim that are a tad bit under pressure as we speak. Power Grid and Infosys as well, not doing that well. Now the rally is fading a bit, so 60 points higher on the Nifty, already given up some of its first tick gains. Sensex up about 230 points. So suffice to say that this could be a very, very volatile day. The pullback has come through, but it's not sustaining at higher levels. There is definitely some selling pressure coming in. GAIL, NALCO, ITC, Infosys are a couple of stocks that are on the downside this morning. While on the upside, a lot of Adani Group stocks. Adani Green is up about 4% as well. But a decent opening. Let's see how the day progresses.
Well, that's right, Sonia. A couple of these stocks that are reacting post large trades. You had HDFC AMC, there was a large trade that took place out there. GQG Partners, they exited, a bulk of their stake. It is likely to be a clean out trade. So that one has opened up with a gain of around 1%. And Harper, interesting to see because SBI Mutual Fund bought that stake, but what is GQG going to do with this money? That's the question mark that the street is working with. So let's see what happens in the coming days. PVR, well, you had Warburg Pincus. There was a sell of shares out there as well. So that one as well, post the last trade, is reacting positively. And PPFA's mutual fund, well, they upped their stake, or they have close to 2% stake in UTI AMC. So I think that one as well has opened up well in the green. So all these three stocks post the last trades have opened up favorably. ONGC as well as Oil India, well, windfall tax cuts have come about. So both those two are reacting mildly positively. And a couple of other smaller names, Jay Kumar Infra, the JV, they have received an LOA for a Bangalore metro project. That's opened up well in the green. You have PNC Infra, intent to award notification coming in from the Haryana Rail Infra Development. So that one as well has opened up well green. And I think Sterling and Wilson as well. That's the other stock over there that's opened up well in the green. Just take a look at that. Big jump is what we're seeing on that stock as well, up close to 5%. They have been declared the successful bidder for NTPC's renewable energy project in Gujarat, and that amounts to 2,100 crores. So a good start, Prashant, but let's see whether or not we can hold on. We've skimmed off some gains already.
50% of the gains, Nigel. So, almost half of what we had on the board when we started in the morning. So, now from being up 90, we're up 45. And the first basic test, of course, if you're looking at things very short term, is that, the index needs to trade above yesterday's high. We did manage to kind of go past yesterday's high, but then quickly pull back. So this is, I'm assuming, like what we've seen, the first of many moves which will play out through the course of the day. All right, a few other names. MRF, if we can pull the stock up, is up 1.6%. The only reason I mention it is because it's coming up with volumes, doesn't trade these many shares this early in the day. Indigo is up about 1.7%, coming up with decent sized volumes. City Gas is something which Nimish was talking about. IGL is up about 3%. 439, 440 on IGL. Sequent is up 5.5%. MGL is up 2%. So IGL earlier, now MGL. UTI AMC, I think we highlighted that, 6.5% on UTI AMC. And there is Triveni Turbine, Phoenix Limited. Those are in the 1.5% gaining list. Market breadth, by the way, is very positive. Some 7:1 in favor of advances at this point in time. Let's look at stuff on the downside. Infi is down about 1/3%, but volumes are huge on Infosys. So it's down 0.4% now, that's it, but large volumes. HAL, that is Hindustan Aeronautics, is down 1.6% on significant volumes. TCS is again down small but large volumes. ITC, GAIL are some of the other. GAIL actually is down about 3.25%. Stocks at about 106. And there is NALCO, which is down about 1/3% or so as well on volumes, which are not small for this point in the day. So, you know, you got the market, which is just about finding its footing, but we're off the highs by about 30 points now. A little bit of the initial sell-off as well. 17,050 is where the index finds itself. Sanjay Mukim is a strategist, head of India equity research at JP Morgan. Sanjay, great to have you with us here. Thank you very much for your time. Prashant this side. Let's just start, Sanjay, with your near to medium term expectations from this market, given all that is going on.
Morning, Prashant. It's good to be on. Well, of course, this has become a very macro market, and India, as I argued in one of my notes recently, we've kind of given up all the premiums we'd earned in 2022 over the S&P or over, let's say, EM, so in relative valuation terms. So India is now back in line with averages to the rest of the world. However, the near-term outlook, Prashant, will depend a lot on what happens to the rest of the world. And to put it in a very sort of, you know, oft-used caricature, whether we get a soft landing to the global monetary situation and economies, or we get a hard landing or not, is the big debate ongoing in markets. Currently people are worried about the potential for a hard landing, some sort of a crisis somewhere, forcing huge cuts to either EPS and valuation. But if the view changes that tomorrow that, look, you're going to get a soft landing instead, because we hear from the Fed, we hear from policymakers that they're going to manage the situation and confidence starts to improve, then maybe India participates in a little bit of a tactical bounce in the near term. So while you're living in the moment, it appears very uncertain and binary. But the good news for India is that we've, in this process, eradicated all the premiums we had over the last few quarters.
All right. Hi, Sanjay. Good morning. As you said, with the recent underperformance, valuations have become a little bit more favorable, from those elevated premium levels, though we are still at a premium in comparison to the globe. How would you approach the Indian markets, though? Stick to the larger cap names? I recall when we last chatted, you were saying you would still be a little bit wary about the broader market, some of those smaller names in the Indian markets. Is that the strategy you still adopt?
It is. And in such sort of uncertain situations, we've always tended to lag and wait for clarity before jumping in, because you are in a slightly more of a capital preservation mode right now. We've been defensive in our portfolio allocation for quite a while, in overweight staples and stuff like that. And I'd stay that way. I'm happy missing the first 5-10% of a recovery, if the Fed comes out dovish tomorrow and tells us everything's fine, and act in response to policy action rather than anticipation of it. Because even today, despite the fact that valuations have become a little bit more comfortable, the potential downsides are still fairly large, right? If you take it down to where the S&P could be on a lower PE or with EPS cuts, there could still be large cuts to asset prices, and we don't want to act ahead of that clarity.
Sanjay, I think you put out a note sometime back looking at these sort of average valuations and how one should read them, right? Just explain that. I mean, it was an interesting point. I looked at on last Friday at close, Nifty 1 year forward P multiple, that was about 17.3. The last 10-year average is about 17. So we're not very far. Of course, now that's a moving number based on earnings and, the P multiples themselves. So just a little bit of sort of explanation on how you think about these comparison now to averages and what's the right way to do it.
Well, my note was provocatively titled, "There is no average PE in India." And the argument there is that if you look for most stocks, and actually for the index as well, the multiples have trended up over the last 15 odd years. I mean, the Nifty has gone from a post-GFC low of 12 to as high as 22 during COVID. And this was driven by expectations of slightly better growth, lower cost of capital, and more importantly, a reduction in equity volatility. So lower volatility meant that equity was perceived as a lower risk asset, which drove the multiple re-rating. All of these situations have changed. And the point I was making in my note is that while the multiple today looks like where it was in 2018 or 2019 for the Nifty, adjusted for growth expectations, the cost of capital, and for the increase in equity volatility, I mean, it's a riskier asset class now than it used to be, markets do not fit, or equities do not fit a DCF just yet, right, in general. So you cannot say that, look, just because it looks lower on the chart, it has become cheap relative to the bond market or relative to growth expectations and so on. If you then do that exercise bottom up and do it individually for stocks, the only sectors that fit that DCF today are banks and parts of the industrial complex, the industrial sectors in India.
Sanjay, if you're talking about banks, will you stick to the large private names, or do you believe some of these PSU banks as well, which have seen a sharper correction after a big outperformance in 2022, would you be looking at them?
At the moment, we stay with the large private banks, and even within the PSUs, the top larger PSUs as such. What we don't want to do at the moment is take lower size, lower beta risks, because the factor that we always forget in cycles is liquidity issues. For investors such as ours, we don't want them to be caught in illiquid situations. We're seeing market liquidity fall, participation in the smaller stocks is reducing, and therefore it is inadvisable to my mind to jump ahead and buy a situation that you cannot then eventually get out of. So again, to kind of reiterate what I said earlier, I'd rather wait for clarity and wait for a view forming on the hard versus soft landing before taking liquidity risks in my portfolio. Therefore, large cap stocks is something that we clearly favor in our portfolios.
Okay, all right. And Sanjay, you said also you've been more defensive, right? Staples, case in point. But what about discretionary names? You stay away from them?
Yes. Now, let me caveat that a bit. On the margin, things have started to look a little bit better for the Indian consumer, and this is driven by two factors. One, oil prices, gas prices, coal prices have come off, and they've come off sharply in the last 5 or 10 days. And this actually on the margin is good for disposable income. Inflation will fall, companies' margins could go up, or companies' volumes should go up if the commodity complex stays this way. If you take a 20 plus year history of Indian markets, relative performance to EM is driven by oil. So when oil goes down, India tends to do better in the EM complex. But fundamentally, it is good for the Indian consumer as well. We did a note a few days ago tracking the job situation in India, and we get a lot of data from the NSSO surveys. And what that also says, that in the December quarter, in December 2022, total salaried and wage jobs in India are estimated to have gotten back to where they were in 2019, pre-pandemic. So we were in a big hole in terms of salaried and wage jobs all through 21 and 22, but we now closed that as well. So consumer confidence on the margin should continue to improve as the employment situation is getting better and as inflation recedes or commodity prices recede. The only catch for the consumer discretionary is that the multiples still remain punchy, especially relative to elevated bond yields. So if I do get, let's say, something cheap enough, on the margin, you would probably look for a slightly positive medium-term view on the consumer space in India.
Right now, Sanjay, in the markets, IT is the one which is selling off. The index itself is down 0.75%, even as the Nifty is up about 1/3% or so. The Nifty IT index is what I'm talking about. Infosys, TCS are losers. Persistent, Tech Mahindra, Coforge. When actually mid-cap IT is doing, Emphasis is selling off harder as compared to large caps. IT services, Sanjay, what's the view now?
We have been cautious for a while, and we continue to remain with that sort of an outlook. And the reason is this is very vulnerable to developments in global banks. It's a proxy in the Indian market to the BFSI space, as we know. And more importantly, these stocks, despite the underperformance, are still trading at small premiums to where they were in 2019. And IT actually, even though I argued that there is no average PE, for Indian IT stocks, the multiples have been relatively stable. So for them to trade at a premium is a little bit of a disconnect. Then we have the 4Q results coming up, in which we expect the companies to provide guidance. And there is risk that the companies are cautious in their guidance and come in at the lower end of expectations, possibly, given what has recently happened in global banks.
Right. Sanjay, just one last question from my side before we wrap things up. Just a quick take on growth itself. I mean, you talk about formal jobs and how they're back at 2019 levels. What's your assessment, I mean, for companies under your coverage? Is demand likely to remain stronger as things stand right now? Is it structurally getting a little weaker? What are you seeing out there?
So there's a glass half full, half empty answer to that question. The half empty answer is that the output gap in India remains significantly negative, which means that the economy is still operating well below capacity. The last RBI update indicated that there is a significant gap still. The half full answer is that the economy is slowly closing that gap. We can see quarter after quarter levels of activity continue to pick up. It's coming in a bit slower than expectations. We're seeing GDP misses and GDP downgrades quarter after quarter. But on trend, it is starting to close. It will take a while before we fully close that gap into my mind. And therefore, the expectations of a very strong 7-8% GDP growth, which is somehow seem to be the base case in India, those seem a bit aggressive. Our forecast for growth next year is 5%. We think it will come in below expectations in FY24.
Right, Sanjay, good speaking with you. Thank you very much. So it's going to be slow. Don't expect things to pick up or have high expectations, low expectations. I mean, I think that's the answer here. Thank you very much, Sanjay. It's always a pleasure speaking with you. By the way, the markets basically come back to the day's highest point, almost the day's highest point. The high today was made at 17,083 and we're about 10 points short at 17,070. So this is the first move we've seen, 90-point move up at open, right after open, 45-50 point sell-off, and basically another 50-point move back up, all within the first 15 minutes of trade. Nigel, we have our first corporate on the show as well.
Well, let's move on then. We have Uno Minda. They have acquired a Kosai stake in the Indian joint ventures in a move to strengthen its four-wheel alloy business. The deal will go through a composite scheme of merger through the share swap. To discuss this and what are the benefits of this, well, we're joined by Mr. Sunil Bohra, the Group Chief Financial Officer. Hi, Mr. Bohra. Good morning. Always good speaking to you. Tell us first, what is the rationale for this particular move?
Yeah. So, you know that the board has actually approved acquisition of the remaining stake in Minda Kosai from our JV partner in the last meeting. So, Minda Kosai will get 100% subsidiary by the end of this month. That was the originally anticipated. So we had another two legal entities or two businesses with our joint venture partner Kosai. One was in the south, which was in the name of Kosai Minda, which was primarily catering to the south-based customers like Toyota, Honda, Nissan, etc. And we had another JV, which was Kosai Minda Mold, which was basically building the molds, or the specialized in building molds for the four-wheeler wheel segment. Now, with Kosai, the MK transaction, obviously, we have been talking to our partner as to if we can simplify the structure by consolidating the position. And they were also keen that Minda takes the control of all the businesses, considering our performance in MKA. So both the three entities, which is Minda Kosai, Kosai Minda Aluminium, and Kosai Minda Mold, all three entities we will be acquiring and merging into Uno Minda Limited, and it will become the arm of a division of Uno Minda. What it will bring on table is definitely a lot of cost synergies, because you'll appreciate maintaining three legal entities, their compliances, management, etc., etc. So there will be operational synergies and saving. Plus, our South India plant, we have always felt that there is a room to do better, and with it coming into Uno Minda fold, our endeavor is that we should reach the KMA performance of the South plant also in line with the North. And the way market is growing, we will need to maybe gradually increase our capacities in South as well to capture the growing demand. So overall, it will simplify the structure, bring a lot of synergies, and bring a lot of advantages to the group in the growing four-wheel alloy wheel segment.
Okay, could you quantify that, Mr. Bohra, then? As of now, since it was in a JV, you all didn't have the entire control. Now, as you said, rationally, you're going in with this consolidation move. So one, how does it help in terms of growth? Do you believe that for this particular segment, growth will come at a faster clip? And if there are cost synergies, I mean, there would be some savings. Could you quantify that?
Yeah, so in terms of saving, definitely you would appreciate that having different businesses, having different procurement teams, different cost structures. So definitely once you consolidate everything, it will bring economies of scale in operations, in people, in resources, in procurement of RM. So we are working with our teams. Once we have already the integration plan laid out, we will work on quantifying all those benefits which we believe should be meaningful for the merged entity. And in terms of growth, we know that in North plant, you will appreciate we have been continuously expanding our capacities. But the South India plant for last 10 years or so have not been having any meaningful expansion while the businesses has been growing. So we would endeavor to capture the lion's share or the major business in South as well. And that will also mean that gradually we increase our penetration in the segment of the business in India.
Sunil, good morning.
Good morning.
In terms of sort of getting technology from them, that continues. Will you have to sign new agreements in that regard? Do the sort of costs, etc., change there? Anything changes?
So nothing changes. Only thing is that we had a joint venture agreement. So you have a technology partner. So instead of a JVA, now it is a technical licensing agreement. So all the contours of support or the cost, etc., remains exactly same. There is no change in that structure.
All right, let's talk about the entity then on the whole. You know, the good news for someone like you, Mr. Bora, is gas prices have cooled off, metal prices have cooled off as well. On the margin, that could be positive, right? I think earlier we were talking about margins of around 11 to around 12% for this fiscal. So there's a tailwind that's there out for you. Operating leverage will play out, input cost is down as well. For the next year, do you believe margins will be better? Could you quantify it, say around 13%, or if you could give us a broad band?
I'm sure you must be wondering why I'm smiling.
No, I'm not, because I'm waiting for that number. I'm hoping for that range, Mr. Bora. I mean, it's a good scenario, right? When things were a little bit uncomfortable, then it's difficult. But when things are good, if you could give us a broad number that you're looking at.
Well, I'll split that into two parts. So one was the pure commodity price softening. So if you remember, a couple of years back, we were battling the front of commodity prices having steep increase. So what we have done over last 24 months, now most of our commodity prices are almost passed through to our customers. So prices up or down, it should have no impact on our margins. Only thing which you rightly mentioned was the gas, which have been speaking in last few quarters, which has impacted negatively of mostly our casting operations where the gas consumption is high, and also in Europe where the energy prices are linked somewhere to the gas prices, etc. So with softening, definitely it will bring in some breather in Europe and also hopefully in Indian business also, because we have also been talking to some of our customers, which are the larger customers, of gas prices also getting indexed as we have some of the commodities like aluminum, copper, steel, etc., etc. So that discussion is also going on with our customers. So if we are able to get through the gas price also indexed as normal commodity prices, then this will also be sort of a pass-through range. So from that perspective, what it will do is, yes, it might not, margin might not expand from 12, 13%, whatever you are talking, but it will bring in stability into our business, into our profitability. And whatever volatilities we are seeing, it's shifted to our customers, right? So from that perspective, we have guided last year also the range of 11 to 12%. And because of all this pressure, we have been actually at the lowest end of the range, maybe around 11.1% for last 9 months. So we do expect that this range will little bit maybe marginally improve, but still remain within the 11 to 12% range for next year as well.
Got that. I mean, you had mentioned, Sunil, that you did not get hurt when prices were rising, so you will not benefit that much also when prices go down. So it should be a neutral-ish, but more constructive kind of environment, as you put it. What's the latest in terms of customer addition, etc.? We had an auto analyst with us earlier who was not sounding too bullish about sort of overall growth rates, etc. But that's an industry comment. What happens with individual companies depends on what their clients do. So tell us a little bit from the last time that we spoke with you, what's been happening in terms of inquiries, new orders, new additions, anything which has moved on those fronts.
Yeah, so definitely we have been seeing a lot of traction with our customers. We have been securing a lot of businesses, and the way we see our kit value, previous model to the new model facelift or a new model launch getting replaced. So we have generally been observing our kit value or share of business improving a little bit across all the businesses. That's number one. Number two, we have been getting a lot of businesses, and that's why you see that today we have almost like 9 expansions currently ongoing in various businesses, be it switching business, be it light business, be it wheel business, two-wheeler, four-wheeler, then four-wheeler switch business. Most of the businesses we are expanding, that is primarily to cater to this increased demand. So we have been very, very optimistic. And while, yes, you are right, industry might be not in our hands to comment. So we don't normally comment on the volumes. But if you see 4 years back, where the industry was to today, we know that one segment, which is two-wheeler, definitely we are seeing that challenges in terms of volumes, not sort of picking up. Volumes are much lower than what they were pre-COVID. And even in the past cars, things are better, but now it's getting a little stable. But if you see from Uno Minda perspective, we were like 6,000 crore top line odd 4 years back. Today, we are at 10,500 crore kind of a run rate in this year. So while industry has remained flattish to negative, we have actually been able to almost double our revenues. And that momentum which we have built, we expect to continue. And our guidance has consistently been whatever industry grows, we should grow at least 1.5x. And we are definitely on that path. And if you see last 4 years, we have actually delivered better than that guidance.
Okay, so what is your estimate for the industry? What is it likely to grow at? Yeah.
That's what I said. We normally don't comment on behalf of our customers because OEM sales or our customer sales is not in our hand. What is in our hand is how much value addition can I do, how much premiumization I can do, how much kit value I can improve, how can I provide more features with the same cost or marginally better cost. So we could talk about things which are controllable. We normally don't talk about things which are not controllable.
All right, Mr. Bora, just one point. You said 10,500 crores odd. I think you'll beat that by a mile because you're already at around 8,400 crores and you're going at a run rate of around 3,000 crores. And when we chatted last, you said that Q4 will either be as good or a little bit better than Q3. So just mathematically, you'll at least end at around 11,300 to around 11,500 crores. Mathematically. Isn't that correct?
You're right. You're right.
Okay.
Sunil, sorry, I picked up you mentioning two-wheeler sales, of course, are struggling. They're below pre-COVID levels. You said passenger cars, there is some softness emerging. Is that right?
I said stabilizing.
Is that what you're saying?
The numbers are stabilizing now. Because we had seen a good run-up in last few months. So current whatever indents we are seeing from customer, they are marginally better, not at the pace which were, but the numbers are still better than what they were in the previous months.
Okay, all right. Maybe stabilizing at a slightly lower level from what we were seeing a little earlier. Thank you very much, Sunil. Great to have you with us here. Thank you very much for your time. Appreciate it. Your comments on CNBC-TV18. We'll take a very quick break here with news that the market is up 50 points. So, I mean, 90 up, 50 down, 50 up, 50 down again. So 17,035, huge volatility with just 40 minutes of trade behind us. We are back with George Alexander Muthurt of Muthurt Finance. He's going to talk to us about demand trends. Gold prices are seeing some solid trends recently. They've gotten past some resistances, etc. So that conversation you don't want to miss. A little later after that, we'll have our special segment, Charting Trends. Midesh helps us decode charts in a slightly medium to longish perspective. Stay with us.